Did you know that there's a pattern that consistently appears right before every major recession? And it's happening again now. And not only that, there are at least two economic indicators that are almost 100% accurate when it comes to predicting a recession. And today, we're diving into a critical topic that everyone needs to know: the undeniable signs that a recession is imminent. We'll explore the historical patterns, the telltale hints that appear time and again before an economic downturn, and most importantly, how you can safeguard your financial future during these turbulent times. Take a look at history and you'll notice every major recession has a telltale sign that most people miss. From market movements to economic data shifts, we'll arm you with the knowledge to stay ahead of the curve. Stay tuned, because understanding these signals could be the difference between financial security and financial turmoil. But before we get into it, my name is Nolan Matthias, and if you want the truth about finances, not the scary stuff, not the stuff that makes you want to buy gold and silver, but the truth, the real realities of what's happening in the economy, this is the place for you. So after this video, if you found it useful, if you found it informative, do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. And if you want more videos like this, turn on the notification bell so you get notified every single time I release new content. Okay, so let's get into it. Let's discuss what always happens before a recession. And in this video, we're going to discuss the key factors and indicators that can pretty much predict that a recession is coming. And by the way, if you've been paying attention, the stock market crash, or correction, I guess I should say, that just recently happened is in fact a telltale sign that the US economy is heading for trouble ahead. But when you understand the key factors that lead to a recession and how the government has to handle them, it becomes really easy to see things coming and also to not worry about them as much as you should, or as much as some people on the internet and places like here on YouTube would convince you that you probably should. So let's start by taking a look at the three signs a recession is coming. And there's three factors in pretty much every single recession that has ever happened in history that play into the beginning of a recession. The first is external factors, the second is psychological factors, and the third is economic factors. And when we get to the economics factors section of this video, we're going to discuss the two, and yes, there's two economic indicators that almost 100% of the time can accurately predict a recession. So let's get into it and first discuss the external factors that lead to a recession. Now, these are the things that are very much outside the control of the government, outside of the control of citizens, and that are very much unpredictable external influences that can lead to bad things happening in the US economy. And it starts with things like global economic slowdowns. So declining international trade volumes or slowing GDP growth in other countries can ultimately lead to an imbalance in trade. And when the US is trading with other countries, or when the US is even importing from other countries like China, what is happening in their economies can very much affect what happens in the US. And even though everything can be fine in the US, external forces can very quickly have an impact. Just take a look at the years following the pandemic, when China basically didn't open up their borders to the rest of the world, and therefore trade went down. Or look at what happened in the Suez Canal when that big cargo ship got stuck and pretty much blocked trade for one of the major trade routes in the world. And these types of things can ultimately lead to major issues in the US economy. Primarily, the issue they led to was inflation, as the amount of goods that were able to be imported, while at the same time the US economy was in a place where there was lots of money to be spent, created an imbalance that eventually led to significant inflation. And yes, there's a whole bunch of arguments to be made for the fact that there was money printing and all of those things. And yes, the money printing led to a scenario where there was lots of money to be spent, but there was also a complete lack of goods to be bought. And that ultimately led to higher interest rates and what is seemingly shaping up to be another recession in the United States. Then, of course, there's geopolitical events. Wars, trade tensions, and political instability in other countries can disrupt markets and economic activities. Take, for example, the war in the Ukraine, which led to sanctions against Russia, which ultimately has led to a significant shift in the way countries are trading, to the point where the BRICS nations are trying to come up with an alternative currency to the US so that they can trade without the risk of economic warfare from the biggest country, at least economically, in the world. And then, of course, there's natural disasters and pandemics. And of course, we all know the effects of the pandemic in 2020 and the serious implications that it had for the US economy. So, these are the types of things, natural disasters, pandemics, geopolitical events, and global economic slowdowns, that nobody sees coming, you don't expect. And as a result, they provide essentially a shock to the economy. And depending on how close the ties are with other countries, depending on how much of the world shuts down in something like the pandemic, or depending on what happens in something like the financial crisis, this can have serious economic impacts that are unforeseeable and that are simply just not things that you would typically expect to happen, but have a major impact on the US economy. Then, next, we have to look at the psychological factors. And by the way, psychological factors play one of the most important roles when it comes to a recession, because a lot of the things that happen in the economic indicators that I'm going to show you a little bit later on are the direct result of these psychological effects that come from consumer confidence, fear and uncertainty, and herd behavior. Now, unlike the external factors, which are completely unpredictable, there are some lead indicators when it comes to these psychological factors. Things like the Consumer Confidence Index, which measures consumer optimism about the economy's future, can give hints as to where the economy is going. And stock market trends can also provide insights into what's going on in the minds of consumers, because essentially, on a short term basis, the stock market can actually act as a voting mechanism for consumers and hedge funds and all sorts of traders. So when things are good or expected to be good, people will drop lots of money into the stock market, causing values to rise. But as there starts to be fear in the economy, people will start pulling money out, hedge funds will start pulling money out, and subsequently that could potentially lead to a recession, and it can be a lead indicator that a recession is coming. Now, at the time of this filming, I want to show you what's going on with consumer confidence, because obviously in 2020 we saw a significant drop in consumer confidence. You can see that right here, and you can see the subsequent recession as a result. Now, when you take a look at consumer confidence today, you can see that consumer confidence is coming down to levels that were not seen since, well, middle or early stages of the pandemic. Now, here's the problem with a recession. You typically don't know that you're in a recession until you're already in it. And that largely has to do with the lag in the GDP data. And in this case, GDP data, which signals whether or not we're in a recession, is in fact a lag indicator. We typically don't know that we're in a recession until 3 to 6 months after we have already been in it. And then when you take a look at the S&P 500, you can see similar sorts of things here where in fact, when the stock market starts to decline, it is often an indicator that a recession is ahead. And that leads us into the more economic factors, the things that clearly signal that there is a recession. Not the sentiment, not the way people are feeling, but the data that clearly shows that a recession is imminent. And there's a few things here that are pretty obvious. The first is an inverted yield curve. Now, full disclosure here, the yield curve has been inverted since pretty much the beginning of the pandemic. And typically when the yield curve is inverted, that is a clear sign that a recession is coming, and it is quite accurate in predicting a recession. It's not 100%, but it's often quite accurate. And an inverted yield curve simply means that short-term interest rates are higher than long-term interest rates. And what this tells us is that there's an expectation that interest rates are going to go up because there's too much inflation and there needs to be a slowdown in the economy, or there's an expected slowdown in the economy. And that is why this signal is so reliable when it comes to predicting a recession. Now, another key indicator is rising interest rates, because obviously when there's inflation and things going on in the economy that causes the Federal Reserve to increase interest rates, that is usually a sign that they're trying to slow down the economy. And the problem with this is that central banks almost always overshoot, which means that when they start increasing interest rates, they are trying to both slow down the economy, but they're also accepting the fact that a recession is going to be the signal that they have done their job. And then last but not least, there's declining consumer spending, which is very much a lead indicator, but it largely comes as a result of the psychological factors that we previously talked about. Now, when it comes to the lead indicators, the things you can look at that help you predict whether or not a recession is coming, Of course, there's the yield curve inversion. There's also durable good orders, which a decline indicates that there's a slowdown in manufacturing and consumer spending. So, in other words, businesses are seeing the spending, the buying within their business starting to slow down, and therefore they're ordering less goods in order to make the products that they produce. And because businesses are run as businesses, they're often very good at predicting what is going to happen in the future. And then there's the SAM rule. And this is where we start to get into the two rules that almost always 100% of the time predict a recession coming. And this is when the unemployment rate rises by 0.5% or more relative to the minimum of the 3 months averages from the previous 12 months. So, in other words, you take the previous 12 months, you look at it on a quarterly basis, and if unemployment rises by more than 0.5% relative to those previous 4 quarters, well, that is a pretty good indication that a recession is coming. And I'm going to show you a chart on that in a second. But then there's also the Conference Board's leading indicator index. And this index is almost 100% accurate when it comes to predicting a recession. And what it does is it looks at 10 different indicators to predict a recession. Now, let's take a look at the SAM rule, and let's also take a look at the Conference Board's leading economic indicator index. Now, you can find the SAM rule at the FRED. Just type in SAM rule FRED. FRED is the St. Louis Reserve Board's economic data resource, which, by the way, is one of the best economic data resources you can find. And you can simply type this in and you can find this chart. And what you can see is pretty much any time this unemployment number creeps above 0.5%, that is typically a sign of a recession. Now, as of filming of this, July 2024, you can see it's above 0.5%. It's 0.53. And in every single other case leading up to pretty much today, when this has happened, there has been a recession imminent. So this is a pretty good sign that we are on the way to a recession. Now, the SAM rule is just one rule. It's one economic factor. It's employment. So what if we looked at more than just the one rule? What if we looked at multiple factors? Well, I'm going to start by showing you the components of the lagging economic index. And this is all data that we get after a recession. And it's important to understand the difference here. This is why I'm going through it. Because sometimes you look at specific data and you're like, oh, everything's fine. But these are the types of things that you can't use to forecast a recession. So things like the average duration of unemployment. That's numbers that you get after a recession has happened. Inventory to sales ratios, labor cost per unit, average prime rate, commercial and industrial loans, consumer installment credit to personal income ratio, and consumer price index for services. These are all things that after the fact tell us whether or not we were actually in a recession, usually about 3 to 6 months late. Now, in comparison, let's take a look at the components of the leading economic index. So these are the lead indicators. These are the things that potentially tell us that a recession is coming. So average weekly hours in manufacturing. If those are going down, it means there's probably less manufacturing, which is a sign that we may be heading for a recession. Then we have average weekly initial claims for unemployment. So more people start applying for unemployment, probably a sign that we are in a recession. Manufacturers' new orders for consumer goods and materials. We've talked about that. The index of new orders, the ISM index of new orders. The manufacturers' new orders for non-defense capital goods, excluding aircraft orders. Building permits for new private housing units. S&P 5 index of stock prices. Leading credit index. Interest rate spread. So this is the yield curve. And then the average consumer expectations for business conditions. And when you take all of these components, this provides us a single indicator that is almost 100% of the time accurate when it comes to predicting a recession. And I want to show you what that looks like. So this is the 6-month growth rate of the LEI. And this chart is very informative in nature because when you take a look at it, it has two things that are clearly defined. The warning signals, which is the black lines. Just because we find ourselves in a situation where there's a warning signal doesn't mean that we're going to find ourselves in a recession. And then there's the recession signal, which is the red line. And when these two things coincide, like they do right now, it is almost 100% guaranteed that we are entering a recession. Now, what's interesting is at the time of this filming, they put out a press release saying that the 6-month growth rate of the LEI has trended less negative, switching off the recession signal. So in other words, we're probably not going to head into a recession. But just before I filmed this video, there was a 600-point decline in the Dow Jones Industrial Average, which means that next month, when this data is released, along with the unemployment numbers that just came out, there's a high likelihood that this number is going to dip back negative and that we are going to find ourselves in 3 to 6 months in an actual recession. And again, here's the problem with the GDP data. So, how a recession is defined is 2 consecutive quarters of negative GDP. But we don't get the GDP data for at least 3 months after the quarter ends. They'll do a preliminary report, then a secondary report, and then a third report, which kind of solidifies the numbers. But at the end of the day, we really don't know if that first quarter was negative GDP until at least 3 months afterwards. And by the time we get the data, we won't know if the quarter we're in is going to be negative until 3 months after that. So, really, we can enter a recession and there can be a full 6 month lag before we have the data to indicate that we are actually in it. And that's why these leading indicators are so important. Because if you take a look at the SAMRL and you take a look at the leading economic indicators index, well, it becomes pretty clear that all of the things that have to happen for us to find ourselves in a recession are happening. And when these two things, which are so good at predicting a recession, are showing a signal that we're in a recession, it becomes pretty obvious that we're probably in one. So then the question is, once you know that you're probably in a recession, what should you do? Well, I heard a great line today on Tom Bilyeu's podcast. It's that I predicted 10 of the last 2 recessions, which in other words, what he was saying is that when you are the type of person who is always a bear, you will very much always be predicting a recession and you will most often be wrong. And the problem with always acting like a bear is that even in the worst recessions, the financial crisis in 2008 and during the pandemic, asset values are almost always increasing. So by acting like a bear and doing things like buying gold and silver or staying all in cash, you actually end up losing a lot of opportunities, especially if you are always thinking that a recession is around the corner. So instead, what you need to do is be very clear about 2 or 3 things. The first is that the single worst position to be in during a recession is to be in a position where you lose your job and have debt. So your first priority should always be to get out of all non-mortgage debt. Then your next priority should be to always be buying assets, stocks, bonds, real estate, whatever you can. And if in fact there is a correction in the stock market, you simply want to go ahead and rebalance your portfolio, buy the things that are cheap, sell the things that have gone up in value, and always be in the market. Because as soon as you take your money out of the market thinking that there's a recession around the corner, well, that's usually when the stock market goes up and you lose every single opportunity to gain more money. And by the way, if you look back over the last 50 to 100 years, if you had missed out on just 7 to 10 days of stock market gains, you would have lost out on almost all of the opportunity to make money in your investments. So it's important that you always stay in the market, but if things do correct, you take the opportunity to rebalance. And by the way, having a balanced portfolio, something like a 60-40 split between stocks and bonds, or if you want to add some precious metals in there for 5 to 10% and commodities, is so, so important. So that you are one, always invested, and two, so that when the market does correct, you can again rebalance and take advantage of the lower prices on the things that have gone down in value. And when the market does correct, make sure you do take that opportunity to rebalance. Anytime there's a significant drop in the value of some of your investments, always take that as an opportunity to buy more of them while selling some of the things that may have gone up in value. And never forget, living in fear gets you nowhere. All it does is it causes you to miss opportunities that could make you substantially better off. Oh, and by the way, there's a lot of people wondering about the US dollar, what happens when the US dollar collapses. Well, if you want to see a video on that, make sure you check out this one right here.